Where you invest your retirement dollars is one of the most important financial decisions you will ever make. However, that is not a one-time decision. It should be fluid based on your needs, how comfortable you are with risk, and what is happening in the economy. The vast majority of retirement accounts are invested heavily in the stock market. Everyone knows the market can go up and down. However, traditional expectations are that stocks will increase over a long enough time frame, even if they can be volatile. But when you are at or near retirement, a good or bad year is much more impactful, especially when you need to take out income. Most guidance points to reducing market risk in your retirement portfolios as you get closer to retirement. This means taking money out of stocks and reallocating to lower risk assets such as bonds, CDs, or treasuries, where returns are primarily based on interest rates. Even though expected returns on these types of assets are lower than the stock market, they are traditionally a lot less volatile. A great example is the early 2000s, when the stock market struggled for 3 years. Having bonds in your retirement portfolio would have lessened the blow of the decreasing stock market during this time. In general, bonds and other similar assets have performed fairly well over the last several decades. One of the primary reasons for this is that we have been in a decreasing interest rate environment, with 10-year Treasury rates as high as 9% in 1990 and going down as low as 0.5% in 2020. That might not seem logical. If bonds are based on interest rates, why would a decreasing interest rate environment be good for bonds? Yields on new bonds do move up or down with interest rates. However, when interest rates decrease, the value of existing bonds actually go up. The opposite is true as well. When interest rates increase, the value of existing bonds actually go down. Here's an example. In 2013, interest rates increased from less than 2% at the beginning of the year to around 3% at the end of the year. That led to negative average bond returns of approximately 2% before adding in management fees. So, where are we today? The stock market is still uncertain, and if you are close to or at retirement, you probably want to mitigate that risk. Historically, that might have meant investing a large portion of your retirement portfolio in bonds or other interest rate-based assets. But if interest rates increase from here, then that will likely have a negative impact on the value of a bond portfolio going forward. Taking the current interest rate environment into account, many feel stuck between two potentially risky choices. Number one, keep a large portion of their retirement portfolios in the stock market and accept the market volatility. Or number two, reallocate to a bond portfolio and either have low yields if interest rates are low, or even worse, negative returns if interest rates increase. The good news is that there are other options. You and your financial professional should discuss whether repositioning a portion of your assets into insurance products designed to address these risks is appropriate for you. These products offer potential for modest growth while protecting your principal. This helps you keep up with inflation in retirement while giving you guarantees that neither decreasing stock values nor increasing interest rates will result in losses. Contact your financial professional today to learn more about alternatives available to address concerns about the stock market in today's interest rate environment.